Welcome to this explainer. Today, we're diving deep into CIBC's massive third-quarter earnings report. Big banks are in the thick of reporting right now, but CIBC just dropped some numbers that literally made Wall Street stop and pay attention. Let's look under the hood of this financial giant to see if this is truly a buying opportunity or if the market is maybe getting a little ahead of itself. Which brings us straight to the million-dollar question, right? Is CIBC stock a screaming buy at current levels, or is it already priced for perfection? When a stock runs this far, this fast, we've got to look past the hype and focus purely on the cold, hard data. So, here is our roadmap for today, to weigh the evidence. First, the Q3 headline numbers. Second, a division-by-division breakdown. Third, the bull versus bear case. And fourth, the final verdict. All right, part 1, the Q3 headline numbers. Let's start with the bottom line. CIBC's net income hit an absolutely massive $2.4 billion for the quarter. To put that into perspective, we're talking about a 15% jump from the exact same period last year. In the world of massive, mature financial institutions, generating a 15% bottom line increase, that is a serious achievement that immediately grabs the market's attention. And they completely smashed the consensus Wall Street estimate. Analysts were expecting $2.52 a share, but CIBC, they actually delivered an adjusted earnings per share of $2.73. That is a 26% year-over-year jump. When you see a beat like that, it basically forces analysts to tear up their models and start over. The top line definitely wasn't slouching either. Revenue came in incredibly strong at $8.37 billion. Just like the net income, this was up 15% year-over-year and landed way ahead of forecasts. So right out of the gate, we're seeing huge beats on both the top and the bottom lines. But you know what? What about the risks? The big worry for banks lately has obviously been loan defaults. Well, CIBC's provisions for credit losses came in at $564 million. And what's absolutely crucial to understand here is that this number is actually lower than what the street was bracing for. By setting aside less cash than expected for bad loans, management is basically sending a signal to the market. Hey, we see the current economic stresses, but we've got it under control. Moving right along to part 2, the division-by-division breakdown. Because this earnings beat wasn't just a one-trick pony. We are seeing some seriously broad-based strength here. Canadian banking profit rose 17%, capital markets just exploded, up 34%. U.S. commercial banking grew by 23%, and wealth management saw really steady growth, up 8%. Literally, almost every single major division contributed double-digit growth to this massive quarter. Let's zoom in on that Canadian banking division for a second, because it really is the cash cow of the whole operation. That 17% profit jump was heavily driven by an expansion in their net interest margin, which currently sits at 2.07%. Now, this is simply the spread between what a bank pays its depositors and what it charges its borrowers. In plain English, with interest rates sitting where they are right now, it's providing this huge tailwind for CIBC to just rake in more money on that spread. When you combine that Canadian cash cow with the other divisions, the full picture comes into focus. Capital markets capitalized heavily on recent market volatility, seeing a huge surge in equity trading and advisory fees. Meanwhile, U.S. commercial is successfully expanding south of the border, and wealth management is seeing reliable asset growth. Add all of that up, and you've got a diversified bank that is, quite literally, firing on all cylinders. Which brings us to part 3, the bull versus bear case. This is where things get really interesting, because there's a very stark contrast here. On the bull side, you've got this well-oiled machine boasting a 13.4% CET1 ratio. That is a fortress of a balance sheet. They're returning capital with a super solid dividend yield, and they're rolling out AI initiatives to drive future cost savings and efficiency. But look at the bear side. The stock is trading near its 52-week high, and forward price-to-earnings multiples are hitting decade highs. The market is literally pricing in perfection right now. If there's even a minor hiccup, like, say, a credit crunch driven by record Canadian consumer debt and looming mortgage renewals, this stock has a long, long way to fall. Provisions might be stable today, but historically speaking, they're still elevated. So how are analysts weighing all this? Right now, the average price target sits around $167 Canadian. Now, some firms do have targets as high as 180, implying there's still some upside left on the table. But honestly, given those macro risks we just talked about, it confirms this isn't exactly an absolute slam dunk. The easy money, it might have already been made. Let's wrap this up with part 4, the final verdict. Operationally, there is zero debate. this quarter was a total home run. But remember, investing is always an equation of price versus value. And because the stock is priced for near perfection right now, the consensus takeaway is a hold. If you're a long-term dividend investor, it makes total sense to hold on and get paid while you wait. But for a new buyer looking for an entry point, the data strongly suggests you might want to patiently wait for a broader market pullback so you can find a much more attractive risk-to-reward ratio.
Going forward, whether you're holding or just sitting on the sidelines, there are a few key metrics you need to keep a very watchful eye on. First, credit quality. Watch closely to see if those loan loss provisions start creeping back up. Second, interest rate movements, because as we know, they directly impact that crucial net interest margin. And third, the impact of upcoming mortgage renewals on everyday consumer health. If consumers start defaulting en masse, well, that bear case we talked about is going to start materializing very, very quickly.
And that brings us to the end of our analysis. We've seen the incredible, undeniable growth, but we also can't ignore the valuation risks at these multi-year highs. That's the core takeaway from this explainer. But ultimately, the market is made up of millions of differing opinions. So I'd love to know what you think based on these numbers. Are you buying, selling, or holding CIBC right now? Drop your strategy in the comments below.